The average home in Canada now costs just under $680,000. How much do you actually need to earn to afford that? Is it $80,000? Is it $120,000? Or are we talking six figures plus? No debt and perfect credit. If you're even thinking about buying a home, this video is your crash course. We'll walk you through everything that you need to qualify: income, credit score, down payment, and the hidden costs that no one else talks about. Let's jump in. To afford a $680,000 home, lenders look at your household income and how much of it would go towards housing costs. They use something called debt service ratios, but here's the simple idea: gross income. Lenders consider your gross income your income before taxes and deductions. For example, if you earn $80,000 a year, your gross monthly income is $6,667. They don't use your take-home pay, but the pre-tax number. Typically, banks don't want your housing costs to eat up more than 35 to 39% of your gross income. This is called the gross debt service ratio. Housing costs include your mortgage payment, property taxes, heating, and half of any condo fees. If you have other debts, they look at the total debt payments versus income. That's the total debt service ratio. Usually, all your debts, including the mortgage, should stay under 40 to 44% of your gross income. In other words, if you make $10,000 a month before tax, lenders want all of your debt payments to be no more than $4,400. What does this mean in practice? It means you generally need a high enough income to comfortably cover a $680,000 home's mortgage payments. As a very rough rule of thumb, many buyers can afford a home priced around 4 to 5 times their household income, depending on interest rates and debts. Why so high? Because lenders calculate your ability to pay not at the interest rate you'll actually get, but a higher test rate. I'll explain this stress test in a moment. The higher the rate, the less you can borrow on the same income, meaning you need more income to afford the same house. So if you're aiming for that $680,000 home, be prepared that the bank will want to see solid earnings. For salaried employees, you'll usually need to show proof like job letters, pay stubs, and T4s to verify this income. If you're self-employed or you run a business or on a contract, lenders use a different approach, often averaging your income over 2 years and looking at your tax returns. It can get complicated, so be sure to reach out to a mortgage professional for guidance on self-employed or salaried income scenarios. Your credit score is a number that shows how well you've managed debt. In Canada, credit scores range from 300 to 900. The higher, the better. So what do you need to get a mortgage? Aim for around 680 and above. In general, you'll want a score of 680 or higher to have access to most lenders and the best rates. Major banks often set 680 as kind of a cutoff for unproblematic applications. If you're in the mid 700s or 800s, even better. Is below 680 a deal breaker? Not necessarily, but it gets trickier. Most lenders in Canada will not approve a mortgage if your score is too low. If your score is in the 600 to 679 range, some lenders might still work with you, but they could enforce more conservative debt ratio limits. 600 is generally the absolute minimum for at least one borrower to even qualify for default insured mortgages. Scores under 600 are very hard to get approved. You might have to go to a specialized or B lender and face higher rates and extra fees. If your credit isn't 680 yet, take some time to improve it before home shopping. Pay all your bills on time, pay down credit card balances, and avoid taking new loans. Even a small bump in your score can not only help you qualify, but also get a lower interest rate on your mortgage. In short, good credit opens up doors. Lenders see a high score and feel confident that you'll pay them back. Poor credit makes them nervous, so they might lend you less or not at all. Check your score early in your home buying journey so there are no surprises. Next up, we're talking about down payment. This is the cash that you're going to put toward the home up front. Canada has specific rules on the minimum down payment. You must have at least 5% of the purchase price as a down payment if the home costs $500,000 or less. For homes between $500,000 and $999,000, it's a bit more complicated. It's 5% on the first $500,000 and then 10% on the portion above $500,000. For example, on a $680,000 home, the minimum down payment isn't just 5% of $680,000. It would be 5% on the first $500,000, which is $25,000, plus 10% on the remaining $180,000, which is $18,000, and that totals $43,000 as the least amount that you need to put down. While 5 to 10% is the minimum down payment for $680,000, 20% down is considered a conventional mortgage. On $680,000, 20% is $136,000. That's a lot of money, but it comes with advantages. You won't need to pay mortgage default insurance, and you'll have a smaller mortgage, meaning lower monthly payments. So what's right for you? Many first-time buyers go with the minimum down payment if 20% isn't feasible. Just know that that means borrowing more and paying an insurance premium. If you can manage 20%, you'll save on insurance and have more equity from day one. There are also options in between, whether it be a 10 or 15% down payment. Any down payment less than 20% will require insurance, but putting more than the minimum will reduce your loan size and the insurance premium a bit. Just a very quick note on down payments. They can come from things like savings, RSPs, the home buyer's plan, or even a family gift. Just make sure it's in your account in time. Lenders will ask for proof of down payment source and that you've had the money for a while to ensure that it's not a new loan. Do you have a car loan, student loan, credit card payment, or monthly debt bills? Those will impact how much house you can afford big time. As mentioned in the income section, lenders look at your total debt servicing ratio. That's the percentage of your income that goes to all debt payments, including the new mortgage. If you have an existing debt, that eats into that limit. For example, if lenders allow up to 44% of your gross income toward all debts, and you already spend, say, 10% on a car loan and the credit cards, then there's only 34% left of your income for the mortgage. That reduces the mortgage amount that you can get approved for. Think of it this way, every dollar in monthly debt reduces your home buying power. In fact, a common rule is that for roughly every $100 in monthly debt payments, you might qualify for about $8,000 to $10,000 less in mortgage. So a $500 a month car payment could slash your maximum house price by in the order of $50,000. This is why financial coaches often suggest paying down debts before applying for a mortgage. It can significantly boost what you qualify for. So if you're looking for some action items, list out your monthly obligations: car lease, loan, credit card minimum, student loans, lines of credit, child support, etc. Lenders will take all of these into account. If possible, reduce debt before home shopping. Pay off credit cards or loans if you can. Not only can it improve your credit score, it directly improves your borrowing capacity for a home and helps you reduce monthly costs. Without further preamble, let's head to the internet. So let's first of all just enter in that purchase price, $680,000. The next thing we're going to do is we're just going to throw in an average interest rate. For this example, let's use 4.29%. For the down payment, we touched on this earlier, it's going to be 5% on the first $500,000, and then anything above $500,000 is going to need a 10% down payment. So in this case, that's going to be $43,000. The amortization, because this is a new home, we can use a 30-year amortization if you are either buying a brand new home or a first-time home buyer. Property taxes, we're just going to estimate 1% of the purchase price. When we get up to the higher purchase prices, it's not likely it's going to cost you quite that much, but for our example here today, that's what we'll use. Heating costs, we'll throw in $100 here. And then for this example, let's just say that they have debts of around $800, and we're going to calculate out what it's going to take for their income in order to qualify for this property. And we're going to see it in the bottom left here. You would need $147,243 in income to qualify for the average house in Canada. Now, the second part of this is, what if you have a large monthly debt on top of kind of this standard $800? What if we have, let's say, a large truck payment, the $1,200 a month? So we go from $800 to $2,000. Now, pay attention. Before, it was going to take us $147,000 of income. Now, it's going to increase to $177,000, or almost $178,000. So the lesson here is, when you're in the home buying process, be really careful with the amount of debt that you're taking on, as it is going to limit your ability to qualify for a home. Mortgage debt is some of the hardest debt to incur, and so things like auto loans and credit cards are much easier to take on. And so if getting a truck and a home is a priority, make sure you prioritize the home before getting into that vehicle. By understanding the basics of income, credit, and down payment, you are way ahead of most first-time buyers. Buying a home, especially a $680,000 home in Canada, might seem daunting, but with the right preparation, it's totally doable. Keep a calm and realistic approach. Know your numbers, get your documents in order, and don't be afraid to ask professionals questions along the way. If you love this video, subscribe for more content that will change your financial future.